Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. With inflation now running at 5.5% and predicted to rise, many investors are concerned about how inflation is going to impact their portfolios. So how are investment company managers handling inflation to protect shareholders? And what are the greatest risks to investors if inflation continues to rise? Today, I'm delighted to be joined by three investment company managers: Ben Ritchie, manager of Dunedin Income Growth; Charlotte Yonge, manager of Personal Assets Trust; and Nick Brind, manager of Polar Capital Global Financials. Right, on to the questions. What impact do you think inflation will have on your investment company, and how are you protecting shareholders from inflation? And I'm going to ask that question to Charlotte.
Thanks, Annabel. I think most importantly, we're looking to preserve capital. So we are looking to keep up with inflation and ultimately exceed it over the long run. And so for us, just part of the mandate is that real capital protection angle. And to do that, we're invested in index-linked bonds, and we're invested in gold, index-linked clearly being inflation protected and correlated their prices inversely with real yields, gold being that currency that's been around for millennia, but which ultimately central banks can't print more of, they can't devalue it.
Great. And Ben, what impact do you think inflation will have on your company, and how are you protecting shareholders?
It's very much a balance, I think, in terms of trying to invest in high quality companies that can prove to be resilient, whether we're operating in tougher times or more inflationary times, hoping to participate if there is higher levels of nominal growth. Hopefully that's going to drive higher levels of revenue, profit, cash flow, and ultimately dividends for us as investors. So that's really, I think, the important part that we will do. We'll select those high quality businesses, and those revenues and dividend streams will come back to us within the portfolio. I think on the other side, in terms of offsets, higher inflation is probably likely to drive higher real yields. That's probably likely to put a bit of pressure on valuations of some of the better quality companies which we have in the portfolio. So there's a bit of a balancing act between these two dynamics. But we think over the medium term, we think the portfolio is reasonably well positioned with companies that have got lots of pricing power, wide margins, and lots of opportunities for growth to be able to manage through what's going to be quite a challenging situation.
Well, that's reassuring for investors. Nick, what's the impact of inflation on your company, and how are you protecting or even benefiting? Your shareholders are benefiting from inflation.
Yes, we only focus on financials, and financials, in particular banks, and to a slightly less extent insurance companies, are the most sensitive sectors to rising bond yields and interest rates. So to the extent that inflation leads to higher interest rates, then that's great for the sector. Loans reprice, margins expand for banks, and their earnings go up sharply as a result. The trust has about 65% of its portfolio in banks, and therefore should be a big beneficiary of those trends.
Absolutely, your shareholders definitely will benefit. Ben, what are the risks to investors in an environment with higher inflation rates?
I think there are really two things to think about. I think, first of all, what's the impact on the profitability of the companies that you've got within the portfolio? And I'm very much coming at this from an equities perspective. So how will inflation affect the profitability of businesses? I think to that degree, I feel very comfortable about our portfolio. And in actual fact, I think we may even profit as a result of that. I think on the other side, you've got this potential increase in short-term interest rates, potentially an increase in longer term interest rates. And as we see both of those dynamics, that's likely to put pressure on valuation multiples. And so you've got this dynamic of perhaps higher revenues and higher profits, but at the same time, a higher discount rate, which is going to counteract that. And so, as ever, it's something of a balancing act between those two elements over time. As Nick talked about, there are going to be some companies which will directly benefit from higher interest rates coming through. There'll be companies within the commodity space which will benefit from energy and metals prices and so forth being higher as well. So you can take advantage of that positioning those within the portfolio. I think the only thing I would say is that as we do see interest rates go up, the idea of that is to slow the economy. Quite often, some of the companies most sensitive to interest rates from a positive perspective on their earnings are also the most cyclical businesses as well. And so you do have to weigh those two things against each other. It's not just as straightforward as this is a hedge, don't worry, it's a one-way bet. You do need to think about a number of the interactions that are playing out there as well. So I think, quite a complex environment for investors to navigate at the moment.
Absolutely, and you're quite right. It is a balancing act for investors, really. Nick, what are the risks to investors in an environment with higher inflation rates? I mean, obviously, we've just said that your shareholders would benefit from higher inflation.
Yes, I mean, there are quite significant risks in a high inflationary environment. As Ben alluded to, higher interest rates historically have been there to slow the growth of economy, try and cap growth and inflation, and that has obviously consequences on growth and therefore earnings and profits, etc., for businesses. So if we saw inflation start to go back to the levels we saw pre-pandemic, and central banks are more confident about rising interest rates, then they have some concern about what that impact could be on markets, increased volatility, or as investors try and reposition their portfolios to whether it's move them more defensively or position themselves in those companies they think that will be, beneficiaries. So it's an area you've got to be, effectively watch the runes and see where it's going and be quick.
Absolutely. And Charlotte, what's your view on the risk to investors in a high inflation environment?
Yeah, I would echo what Ben and Nick have said. I mean, it's very uncertain, and because we haven't had proper inflation since the 70s and 80s, the constituents of the stock market have totally changed. So you can look at how different sectors behave, but ultimately, lots of these businesses, these business models are new. So I think what's most important, and as Ben has said, pricing power, absolutely critical, not overpaying. So you're not subject to higher discount rates, really derating your equities. And then when it comes to debt markets, where we also clearly invest, I think conventional bonds are really for the birds. You will not get a lot of upside with yields at this level and the risk of them, particularly in the short term, rising more. So in that area of the market, inflation-linked bonds are our preference.
Absolutely. And Nick, where are you seeing the greatest opportunities at the moment?
Well, we touched on banks initially as being obviously significant beneficiaries of rising interest rates and bond yields. But another area we like is non-life insurance. So you think of companies like, Direct Line or Chubb and Arch in the US. And they're historically very counter-cyclical, very defensive. Their earnings aren't driven by economic cycle, but by claims, accidents, and so forth. And since the pandemic, they've pretty much lagged equity markets because of that defensive nature, as people have either played growth at one end of the barbell, or maybe reopening and cyclical stocks at the other. So we started to see a bit better relative performance coming from them, and we've been adding to them and think they're actually have an interest, attractive outlook over the next 2, 3, 4 years.
Right. And Charlotte, you mentioned inflation-linked bonds. Is that where you're seeing the greatest opportunities at the moment?
Yeah, we have slightly increased our duration recently in our index links. And I mentioned the price that is factored in, the rate of inflation that these securities are currently pricing is pretty low, given the uncertainty and the risk of an overshoot. So if you look at the US Treasury inflation protected security market, that is currently for the 10-year duration, sort of Xing out the next 5 years, the following 5 years, as reflected in the forwards, basically saying that the Fed or the inflation rate is going to be around the Fed's target, a little bit below, actually, it's 2%. So there's no premium there for inflation uncertainty, and there's certainly no expectation of a sustained overshoot. And we think particularly that part of index-linked bonds is pretty attractively valued.
Definitely. So I'd like to ask Ben, and this is a difficult question, I know. What is your outlook for inflation going forward? And perhaps has the situation in Ukraine increased inflationary pressures?
Well, I think the situation in Ukraine, I think, has really amplified the issues which we had before, right? So on the one hand, you've now got increasing near-term inflationary pressures, so commodity prices going up, across the board. Russia and Ukraine are large producers of all sorts of things, from wheat to gas and oil. So that's definitely happening. But on the other side, if we were worried that at some point in 22 or 23, we might see the start of a slowdown, perhaps maybe economies move through into a more mature phase in the cycle, people start to talk about recession, I think the risk of that has also just significantly elevated as well in terms of demand. So you've got to play these two things against each other, which I think is going to make investing quite interesting. If you'd have asked me where I think the best opportunities sit for our portfolio at about 4 a.m. on Thursday morning, I would have said it's in the companies that are in our portfolio. Probably still say that, but I probably wouldn't be sitting there jumping up and down with excitement, whereas at that point, I felt that there were some really quite attractive opportunities and some really good companies which had been derated by 5, 10, 15 PE points over the last 6 to 8 weeks. I think in the last sort of 3 to 4 days with everything that's happened in Ukraine, I'm probably a little bit more circumspect. But I think it's going to be quite a challenging situation to be able to navigate. And as we saw perhaps back in 2008, I think particularly, it takes a while for the impact of some of these events to feed their way through into financial markets. So if you think about Lehman Brothers, when it went bust, it really wasn't for 3 or 4 weeks before financial markets really started to reflect the full stress that caused. Arguably, this is potentially quite it's a different situation. It's not just about banks, but it is about the interaction of the financial system. The complexities and challenges which we might face might be quite significant over coming weeks and months. And so, I think it probably pays for investors to be, looking for opportunities, but also being quite judicious as well at the moment.
I think you're completely right, and it's such an uncertain environment at the moment. But it's good that investors, can look for opportunities, but of course they should be very careful too. Nick, what's your outlook for inflation going forward? And again, bringing in the Ukraine situation.
Yes, I mean, I would agree with Ben. I mean, incredibly difficult to, work out where it's going exactly. And as the US economist J.K. Galbraith said, there's two kinds of forecasters, those who don't know and those who don't know they don't know. And I'd put us very much in the former camp. The only thing we can say is forecasts are going to be wrong, but we just don't know which direction by how much. So, but, from obviously the shocking events that have happened in Ukraine, I think the risk obviously in the short run is that it's going to go higher, and that will have markets as we've seen.
Yeah, that is an absolutely great quote by J.K. Galbraith, something that we should all remember. All predictions are generally wrong. But yeah, very sad scenes from Ukraine, and obviously that will lead to inflationary pressures. Charlotte, what's your outlook for inflation going forward?
Yeah, similarly, we're keeping really open-minded, and it's really just our job to think about, what are the potential risks? What are the different scenarios that we're faced with? And where have the risks changed? And I do think we have, versus the financial crisis, where you saw quite a quick return to austerity. There was clearly monetary stimulus, but nothing like the fiscal stimulus that we've seen in response to COVID. There is a risk now of inflation that wasn't there in the real economy. That you had asset price inflation then. Now, actually, there have been transfers of, for example, COVID disbursements in the US into people's bank accounts. So people who might actually and who are actually spending it. And this is a transmission mechanism that is needed for inflation to actually occur. So I think watch this space, and wage inflation is going to be a really important driver of whether this current inflationary bout is sustained, how wages respond to that higher cost of living, because ultimately that will and should, if it does sustain, that will underpin demand going forward, and then it impacts all areas of inflation, not just the goods prices, not just the energy prices that we're seeing currently.
Yeah, so that could be more sustained inflation across the board. Well, plenty to think about there. I'm wondering, Charlotte, what benefits do you think the investment company structure has in an inflationary environment?
So one great thing about the investment company structure with personal assets trust is we can actually hold physical gold. And I think in inflation, gold is a really important asset. Ultimately, people refer to it as a commodity. It's really a currency. It's a currency that, unlike the fiat versions, it's limited in its supply, but it also tends to be a very good hedge against periods of geopolitical uncertainty in particular. So we are seeing today, in the last few days and weeks, gold start to come into its own as people are looking for that safe haven, and having that physical gold, knowing that you can, and we have visited the gold, touch the bars, you can take delivery of that gold. That's incredibly important as security on something which ultimately can't be debased in the same way.
Yeah, absolutely. And fiat currencies, obviously currencies backed by a government. But, gold, a real asset. I think you're quite right. It's amazing that you can hold and of course, the closed-ended investment company structure is ideal. Ben, what benefits do you think the investment company structure has in an inflation environment for your company?
Well, I think the sort of three kind of main things, Annabel, I think I'd point to. I think, first of all, we have revenue reserves, which are able to be built up over time, and they allow us to smooth out our dividend distributions to investors. So if we do find ourselves in the environment where earnings are not meeting our dividend commitment, or perhaps keeping up with inflation, we have some flexibility to either fill in a hole or to add a little bit more to our distributions from those revenue reserves. So I think that's quite important. I think the other thing then is that, generally speaking, the fees and costs of investment trusts are quite low compared to their open-ended brethren. So again, that should help offset perhaps if there is some erosion of return for investors. That will help them. And again, that can be quite meaningful. 40, 50 basis points might not sound very much, but when the long-term return on equities is 8-9%, that's quite a big percentage of that. That compounded over time can make a big difference. And again, I think one of the things which will also help offset returns will be leverage. We have relatively modest leverage in Digit. It's about 8% or so of net assets. But if we are in an environment where we do see sort of higher nominal growth driving, higher profits, and that feeding through to higher share prices, then that should allow us again to be able to sort of slightly accentuate the returns that are available to investors over time. So I think there are a number of clear advantages to the investment trust structure for investors.
Absolutely, and clearly the income benefits, the use of revenue reserves to maintain and increase dividends, something that investors find incredibly reassuring. And it's something that's really unique to the investment trust structure. And during the pandemic, for example, in 2020, I'm pleased to say that 85% of equity investment companies which pay a dividend over 1% maintained or increased that dividend, which if you compare with the open-ended equivalents, only 23% did. So dividends very reassuring for investors, particularly in volatile and difficult markets. I'd like to thank our managers very much for joining us today. It's been great to hear the outlook for inflation and how their investment companies aim to protect shareholders in an inflationary environment. I'd like to emphasise that we don't know what's going to happen in the future. Investment is for the long term, and it's important to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. Thank you so much for watching.